guys, and welcome to another YouTube clip. Today we're going to take a look at finance, and we're going to be looking at our very first lesson on financial processes. These are the set of steps or things that a business does in relation to financial management. E.g., a business will keep budgets as part of its financial processes. We use financial ratios as the usual processes or steps it carries throughout the year. We were looking at the influences, the impact of financial management. From the syllabus dot point, and it's very important that you keep referring back to your syllabus and you making sure you understand what each of those dot points are and you tick them off when you yourself get it. So under this subtopic of process of financial management, we're looking at planning and implementing. Under planning and implementing, we need to look at what financial needs are, budgets, record systems, financial risks and how to avoid them, and putting in place financial controls. This is part of the planning process. We're also going to look at, in terms of planning and implementing, debt and equity financing and the advantages and disadvantages of each, the pros and cons. And we're going to also take a look at matching the terms and source of finance to the correct business purpose. All right, now in terms of planning and implementing, financial planning refers to looking at the long-term strategic objectives of a business and developing a set of budgets and record systems to plan out what funds the business possesses and what expenses the business is likely to incur. Implementing refers to carrying out the actual plans the business has put in place. Now, there's a process that businesses use to plan and implement effectively. This is called the planning cycle. There's 5 steps. 1, 2, 3, 4, 5. 5 steps involved in the planning process. The first one is for a financial manager to determine the financial needs of the business. It's essential. Following that, they need to develop budgets, maintain effective record systems, identify financial risks, and establish financial controls. And these follow and marry in a fair bit with the syllabus. Now I'm just going to go through those 5 key parts of the planning cycle in a bit more detail, because you could be asked a question on that to explain the planning cycle. All right, the first one of those is financial needs. This refers to how the business is traveling financially, and in particular, what financial requirements does the business need? An example, does the business have enough funds, enough coin or cashola, to meet, say, July's outgoings? If not, then we'd say there would be a shortage of cash flow. Problems with meeting its financial needs, we'd see. If in this case, the financial needs of the business were not there, there's an issue, a shortage, then they could get an overdraft facility, be able to get a credit card, a line of credit to be able to address that financial need. It's very important. There's a general process that financial manager goes through. The next stage, as we said in this planning process, is having budgets. This refers to setting up a cost center, like a department. It could be finance, it could be social science, faculty department, math, science, whatever it may well be, who will then plan out future expenses and future incomes that are going to come in, make sure that there's enough income to meet those expected future expenses. The third step in that planning process is record systems. This refers to systems used to record data and information about the business. Now, there's 2 good examples of effective record systems. They are MYOB, standing for Mind Your Own Business, and many small to medium enterprises, even some larger businesses, use MYOB. It's very simple, easy to use, allows you to keep very good records for taxation purposes and to be able to generate ratios and to track how well your business is doing. Another record system that can be used is MIS, standing for Management Information Systems. Okay, and again, these 2 are good specific examples that you can use when you're answering a short answer or longer response essay style question. Right, an example of MIS, that Management Information System, is IBM's Master Data Management Software. Now, why are these things a process? It's a process because it's something a business must do in order to effectively meet their key financial objectives. Right, the next part of the planning process, the second last one, we're getting there, are financial risks, or identifying these financial risks. This refers to a business assessing the various potential financial risks that may occur as a result of running a business. Some examples of potential financial risks include theft of goods, non-payment of accounts receivable, those buggers not paying them, or possible interest rate increases, and so on, dip in sales, those type of things. But the last step in financial controls, or last step in the planning process, is financial controls. This refers to putting in place ways to check, control, to see if the plans of a business that they're put in place are actually occurring. It's kind of like a checklist. Now, some good financial control tools include budgets, cash flow statements. We're going to be looking at these things later on. Future lessons, income statements, balance sheets. If there are any unusual occurrences, then they should sharpen these statements. Now, that's part of the planning process. Tick, done, well done. But under the planning and implementing, we still need to look at debt and equity financing, the pros and cons, and matching the term and source of finance. So if we get on to debt and equity financing, you should be somewhat familiar with this already, but it is part of the general day-to-day job of a financial manager. That's why it's one of these processes. All right, debt financing refers to a business obtaining a loan. Example could be a mortgage, that's a long-term debt financing, or an overdraft, short-term little debt financing. Whereas equity financing refers to a business selling partial ownership of a company to an investor, maybe floating on the ASX. All right, now, again, the following of this is not part of the planning process, okay, but it is part of this planning and implementing in terms of the syllabus. We're going to look at the advantages and disadvantages of debt. Why do you want debt? Who wants debt? No one wants debt. Debt is good sometimes for a business. There's some pros, but there's some things to worry about too. Same with equity. There's some benefits of equity, selling shares, but there's also some downsides. Let's address those. So the advantages of equity, well, some of them include interest repayments are tax deductible. Another advantage are loans provide a business with an opportunity to grow. True. Some disadvantage of debt financing are interest rates can vary over time. If the RBA jack them up, increase them, that could be a worry. You might not be able to service the loan. Okay, and also over time, just in general, interest rates are very costly to the business and you must pay them. On the flip side, equity, pros and cons. The advantage for equity includes both capital and interest do not need to be repaid. Someone's buying part ownership of your business from you through the sale of these shares. You don't have to pay them. You often give dividends, but you don't always have to with the businesses in a bit of strife. All right. Now, a disadvantage, though, is it includes an increasing amount of owners' equity. Okay, so you've got more or additional people owning the company. So you're losing some level of control. And also equity funding, unlike the interest repayments, for the business, it's not tax deductible. Now, the last part of this syllabus dot point on planning and implementing is matching the term and source of finance to the correct business purpose. Now, this refers to getting an appropriate loan for an ideal or appropriate investment or products. I'll give you an example. If I'm going to want to purchase a factory or buy something long term and I need debt financing, say, it's long term, remember, a mortgage would be an appropriate source of finance, okay, for that business purpose. An overdraft facility, which is very short term, high rates of interest, is not. You're not going to be able to have that for a long period of time. It's going to be inefficient, expensive, and not good for the business. So you've got to look at short-term projects, short-term things you want. You might finance through, say, debt. Okay, you don't want those for long-term loans. Same thing, if you need to be able to pay your accounts payable to a business, so I'm a carpenter, I've got to pay Bunnings, then it's a short-term sort of thing. I might use an overdraft facility. I'm not going to go and sell major shares in my company, equity financing, to be able to fund that. It's not matching the correct term and source of finance for the business purpose. That'd be ridiculous. All right, thanks for listening, and I'll see you next time. There, the buzzer said go. Goodbye.